It's oftentimes as dividend investors that you look at a long-term dividend paying chart like this and you see this continually going up with 16 consecutive years of dividend raises, and it's easy to get excited and motivated to invest in a company such as this, but it doesn't show the full picture because it doesn't give you the underlying problems of the business. With lackluster revenue growth for the last half decade, this company has failed to innovate and differentiate itself from its overall what I consider to be commoditized business. It has improved slightly in the last year. It's grew revenue 4%, but it has a long way to go if it wants to improve from these awful balance sheets that it's put itself in over the last couple of years. So we're going to talk about Verizon. Verizon is the company that we're talking about, by the way. This company has released some of its schedules of debt. It has also talked about in its most recent earnings report where it's projecting growth looking like in the future and what it's doing to innovate and reinvent itself and to hopefully pay off some of this horrible debt. And we're also going to talk about why this company has went so far down in share price. Pulling up ticker symbol VZ for Verizon, you can see that year to date, this company's down 32%. In the last year, it's down 34%. And in the last 5 years, if you invested in this company for a half decade, not counting the dividend reinvestments, just the share price alone is down almost 30% on a 5-year investment horizon. And when you consider that the S&P 500 was up dramatically higher than this at around 45%, you can obviously tell that Verizon has underperformed the market, not by a small margin, but by a wide one. So we're going to talk in this video just a brief overview, what I like about the company, what I dislike about it. There's two main pros. We'll go over that in this video, what those two pros are, and then there's two main cons. So if you want to see the two pros, you want to see the two cons, stay tuned. This is going to be a fun one. If you haven't seen me before, my name is Jordan. I'm a millennial investor, and I showcase my portfolio balance in every single video, which is right here sitting at about $42,200, and this is my performance since joining this brokerage. And here's how I break down and I showcase my monthly portfolio balance to you guys that I update at the first of the month, as well as my holdings, which are shown right here, my performance, which is visualized through this chart, as you can see right now, and then my monthly YouTube income that I earn through the channel and my lifetime YouTube income. Now, I also have my portfolios that I shared down below in the description, so check it out if you're interested. We have both the growth and the dividend growth portfolio that is cool to see, and the great part about this brokerage, M1 Finance, among all the awesome features, we can share these pies amongst each other, which is shared down below in the description, which you can see right here as I'm highlighting. And if you want to check it out and you get signed up, you get $10 for getting signed up and you help support me in the channel. So check it out if you guys haven't already, but without further ado, let's go ahead into the two pros and the two cons for Verizon stock. And let's go ahead and get started with the pros. The first one is, if we hop back over into the stock on M1 Finance, you will see this company has a dividend track record of growing consistently over the last 16 years. And then the first pro is the massive dividend yield. This is one of the highest dividend yielding stocks that you can find in the entire public sector. It is ridiculous how high this dividend is, currently as of the most recent quarter, paying about 65 cents per share every single quarter. And what is that? I believe that's $2.60 or so, if I'm doing that math right in my head. And that leads you to a 7% dividend yield from its current share price at around $35. That is amazing. Going back and comparing this to the S&P 500, its current dividend yield is around 1.6%. So to invest in Verizon and get 7% plus, almost 8%, just to sit and hold this company with a growing dividend is amazing. That is one of the first big pros of owning a company like Verizon, and why I think it has lots of opportunity for dividend investors that are looking for a protective, high yield free cash flow that is going to hit their portfolio balances every single month, every single quarter over time as they invest in these type of companies. And then the second pro, there's one second benefit to investing in Verizon, which is that forward PE, which is so ridiculously low, it's almost comical. It's almost laughable. This company originally traded, let's just go back a couple years. Let's go around the peak, which is around November, December of 2020, when this company was almost double where it's at now, at $61.50. Today it trades at $35. Now over time, it has slowly grown those profits, not very much I will say, but it has slowly grown its profits, as you can see from this earnings per share. In the last couple of years, it's had a slight uptrend as of last year, producing $5.32 of earnings per share. And while it's uptrended, as you can see, the share price is downtrended. And this leads me to the second benefit. You're buying this company at a ridiculously low valuation. If you're investing in Verizon today, you're buying it at a 7 forward PE ratio. 7. So just so you know, as of the average, last I checked, I think the average in the market is 17. So you could literally double this company's share price and it would still be far below the average. That's amazing. Now we know the two benefits. We know that it has an extremely high dividend yield. Just owning this company, it pays you about 7% per year if you assume that they'll pay out that dividend. And you also know that you're paying for pennies on the dollar compared to almost all other companies in the market. And so that leads me to the question, why is this company bid down so low? Well, if we hop over to their guidance here for 2022, you can see that it doesn't look that great. Their EBITDA growth, which is kind of like another form of profits. EBITDA, by the way, if you don't know, stands of earnings before interest, taxes, depreciation, and amortization. And they're projecting negative 1.5 to flat, 0% for the year of 2022. Also, their service and other revenue growth is negative to 0% guidance. The only thing that's positive is their total wireless service revenue growth, which is about a 9% guide, but that's not super impressive when you consider that inflation has been running at that percent or even hotter over the last year. So that's kind of okay, and so far their revenue hasn't even hit these guidance metrics, which by the way, if we hop over to their quarterly revenue, it's at almost record highs at a record $34.24 billion per the quarter, and it only grew 4%. And this company has generally been growing its revenue on a 10 and 1 year basis. You can see that it generally grows anywhere from about 1 to 4%. So this 4 that they just reported, as of late in the last decade, that's actually a high number. Normally this company only grows 1, 2, maybe 3% a year, and that's it. And so that's the two cons that I want to talk about. The first one being that this company cannot grow. It is a commoditized product, and what is to prevent you once you join Verizon to leave to another company like an AT&T or a Sprint or a Cricket Wireless or a whatever, fill in the blank, US Cellular. There's so many other names out there, and there's nothing really determining where you go to other than the price. So this revenue chart has gone flat since about 2015, as it should, until this company can find a way to differentiate its product or find a way to make consumers pay more without leaving, which is unlikely. I think that we'll likely see this share price stay around the $30, $40, $50 range. And another thing I might add is that the 10-year Treasury, which determines a lot of this company's valuation, has been skyrocketing over the last 2 years. The 10-year Treasury was in 2020 at around 0.5 to 0.75%. Rock bottom prices, rock bottom interest rates. And now the 10-year pays 4.2%. And obviously this is a non-risk asset. With Verizon paying 7%, it's a risky company, which leads me to the biggest con of all, and by far the main reason why I've considered not taking this company into the portfolio going into 2023. It's a very small 2% weighting, but it leads me to this god-awful balance sheet. Let's look at the cash first. Let's look at this, okay? As of the most recent quarter, you can see that they had about $2 billion in cash on the balance sheet. Now, out of that $2 billion that they have outstanding, ready to go in their checking account, ready to deploy for any scenario, how much debt on the complete opposite? On the flip side, how much debt does this company have? They have $2 billion in cash, and they have $128 billion in debt. $128 billion. If you didn't hear me right, let me repeat that. $2 billion in cash. Look at them compared side by side. See the little green of the chart right here where my mouse is? It's really hard to see. This shows you the dramatic differences between the cash piles and the debt piles. 2 versus 128 billion, and while it has made slight improvements over the last year or so from 146 down to 128, we're still far beyond what I consider to be a healthy balance sheet. If you look at their schedules of their outstanding debt, I'm going to turn on the little auto scroll here, and you can see how many billions of dollars is scheduled to be paid between now and the next couple of decades. And some of the interest rates on these debt are not very good at all. Look at one we just passed, says 7.85%. That is ridiculously high. Some of these are low at 1, 2, 3%, but many of them are in the high single digits. Some of them are 5, 6, 7, 8%. And this company is just drowning in debt. Now, they can pay it. They have plenty of free cash flow, which we're about to show right now, and they can service this debt for now, and they're easily making their payments, and they haven't missed any bond payments or anything of the sort. But this leads me to, what are they doing in terms of their free cash flow? And you can see that it's pretty much flat throughout the last several years. Going back to about 2009, since the Great Recession, this company's produced anywhere from about 3 to 5 billion in free cash flow every quarter. And what are they doing today? About the same numbers, about 3 to 5 billion or so, with little to no growth. As of the most recent quarter, which was right here at 5.74 billion, it actually didn't increase, it decreased 4.8%, and over the last 2 years has went down 18%. So this company, in my opinion, is one that is drowning in debt. They aren't buying back shares because they don't have the money to, and while the dividend is rising, you can notice that the rises are so small, from 59 to 60. That's like a 1.5% raise. And then the most recent from 64 to 65%. That's just over a 1% raise. They can't afford to raise the dividend any faster than about 1% or so per year, because if not, this company will eat away all of its free cash flow. So Verizon has two pros. It's extremely low valuation. It's incredibly high dividend yield, currently at 7+%. Going to be likely 8% soon. And this company has two major cons. The first one is top line revenue growth. The company has trouble growing, and I think that this will continue until they can find a way to differentiate themselves. And then the second con, which is their ridiculously an insane balance sheet that just should not exist in the public markets. With a debt pile of $128 billion and a cash pile of only $2 billion, it just shows how insane this balance sheet is, and the fact that they were able to raise this much is quite shocking. So I think that this company will struggle for a while. I think that it will continue to go down as long as the 10-year Treasury stays this level or even continues to go higher. This company trades at like a bond-like company, realistically, and until this 10-year Treasury goes down, I think that Verizon will likely stay at these prices at $35 a share or be even lower. So if you want to own this company for its defensiveness, for its reliable dividend yield of 7+%, then now's the time to own it. But if you want to own a company that does not grow and has a risky balance sheet, then I would likely stay away from it. It's for you to decide, and it was down another $1.65 or about 4.5% just last Friday alone. So thank you guys so much for watching. I appreciate you watching to the end. Subscribe if you haven't already. Check out all the stuff down below in the description. And without further ado, my name is Jordan. I'm a millennial investor, and I'll catch you guys next time.